Taiwan Semiconductors, or TSMC, has been in the news a lot lately because there's a huge shortage of chips. PlayStation 5 deliveries are severely delayed, entire car factories have halted production, video cards are short, and so on. But how did this all happen, and what does it mean for Taiwan Semiconductors and the many companies that rely on their chips? In today's episode we are going to explore that question, and we're going to look at the business and financials of Taiwan Semiconductors, ticker TSM, to find out if Taiwan Semiconductors is worth buying and if the current situation might pose a problem. Let's start with a quick glance at their price performance. They have increased 168% in price over the last year, but so have many other stocks in the last year, so that doesn't tell us that much yet. Before you invest in a stock, you have to understand their business. How did Taiwan Semiconductors become such an important company that frankly the world can't really do without anymore? Taiwan Semiconductors was only founded in 1987 in Hsinchu Science Park in Taiwan, and I'm pretty sure I butchered that name. Something I also did not know is that apparently I have some sort of a personal connection with TSMC, since they opened a subsidiary in Amsterdam in 1989, which is about 30 miles away from where I live. What is interesting is that TSMC does not design, manufacture or market any of its products under its own name. But don't be mistaken, the chips that TSMC produces are everywhere. In phones, in cars, in the big data centers of Amazon, the Internet of Things, everywhere. They produce chips for around 500 different customers, which include some of the biggest names in the tech world, such as Apple, Qualcomm, Nvidia, AMD and many more. Even Tesla will have their new self-driving chips produced by TSMC, which is scheduled to start going in mass production in Q4 of 2021. TSMC attributes its success to its business model, where they pioneered the pure-play foundry business model by not designing, producing or marketing any of its products under its own name. They make sure they don't compete with their customers. The key is that in that way TSMC enables its customers to be successful. Another key point was that TSMC started to invest heavily in 2010 in at that time the 28 nanometer process, at a time when the world economy was still suffering from the global financial crisis. This led the way for rapid growth in the years to come. TSMC has 55.6% market share of the semiconductor foundry market and has the largest market cap of all semiconductors with a market cap of 556 billion. That's great, but is TSMC able to protect that market share? In other words, do they have a sustainable competitive advantage or moat? There's a high barrier to entry because chip manufacturing is very capital intensive. As a chip maker, you constantly need to spend a lot of money on R&D to stay ahead of the competition, which is exactly what TSMC is doing. Many of the competitors of TSMC, like AMD and Nvidia, have turned away from being a pure-play chip maker, where they do design and market their chips, but the actual production is done by TSMC. This gives TSMC a lot of power. Recently, even one of their biggest competitors, Intel, is reported to have outsourced some of the production to TSMC. So how did TSMC become the trusted production partner of so many big companies? In their partnership with Apple, the big breakthrough came first in 2015, where TSMC produced the brains of the iPhone 6s and 6s Plus together with Samsung. And then, 1 year later in 2016, for the iPhone 7 and 7 Plus, TSMC became the sole producer for the processors. 2 years later, TSMC had another big breakthrough, where for the first time they were leading the pack of semiconductors. In the world of chip makers, the size of a chip matters a lot. The smaller it is, the more efficient it becomes because it uses less energy, which is vital for phones, cars and everything else that runs on batteries. And in that light, TSMC was the first chip maker to produce the 7nm chip in high volumes, and in 2019 they became the first chip maker to successfully commercialize what is called extreme ultraviolet lithography, or EUV technology, in high volume production. This gave them a lead of at least 2 years compared to Intel, as we know now. Intel is still not able to produce 7nm chips. Many other chip makers discovered it was cheaper for them to outsource their production process to TSMC, making TSMC even more powerful. For perspective, in the year 2000 there were 30 chip makers and now there are only a few left. This progress is also showing in the revenue trend of TSMC, as you can see here. A nice uptrending revenue trend. The benefit of being independent for TSMC is also that they can actually collaborate together with their customers and strategic alliances through their Grand Alliance. TSMC is also good at generating profits, as you can see in this nice uptrending profit trend. They had a little dip in fiscal year 2019 but are well on their way to have higher profits again in fiscal year 2020. We already know that TSMC is the biggest semiconductor in the foundry market in terms of market cap and market share. But who are their competitors and how do they compare on margins? Their biggest direct competitors are probably Intel and Samsung. But some of their competitors are actually also their customers. Intel has the highest gross margin, but the operating or profit margin of TSM is the highest of the three. But first, a bit about this channel. I'm Tom from the Dividend Attitude Show. On this channel I make in-depth videos about dividend stocks, battles between two dividend stocks and portfolio updates on my personal portfolio. As a dividend investor, I'm always interested in knowing what the dividend profile of a company looks like. So does TSMC have a good dividend profile? The current yield is not that high at around 1.5%, but that is in line or even a bit higher than many other tech companies. The dividend growth rates do look more promising though, with a 7.5% 5-year growth rate and a 15% 3-year growth rate. Looking at the dividends here, it does look like they have not raised their dividends since the second quarter of 2019, so I'm not sure what's up with that. The dividend history of TSM must be one of the hardest to get a grip on I have seen so far. They started with paying out in stock dividends in the early 90s, then switched to cash dividends over time, and it seems they consistently started raising their dividends in 2013. Another thing to keep in mind that the original dividends are paid out in new Taiwan dollars, meaning the exchange rate also has an influence on the actual paid out amount in US dollars. Most websites show an inaccurate picture of the dividend history because of this. The earnings payout ratio is around 44%, so that looks quite safe. Surprisingly, the dividend safety score is only at 62, so I'm not sure what's the reason for that. Something else I like to check out is the health of the balance sheet of a company. For that we can use the current, quick and debt to equity ratio, which all show us how leveraged their balance sheet is. The more leverage, the more risk for us investors. The debt to equity ratio trend shows us that TSM has a very low debt to equity ratio, which has been like this for at least the last 10 years. In fact, they have so much cash that they could pay off their long-term debt 20 times over. Interestingly, they have a lot more short-term debt than long-term debt, which I suspect has to do with the rapid production nature of their business. Their current and quick ratio did dip in 2019, full year 2020 numbers are not yet out, but is still quite above 1, which is what I like to see as an investor. Besides the balance sheet, I also would like to know as an investor how good the company is at turning investments and debt into profits. We can get an understanding of this by looking at what is called the return on equity and the return on invested capital. Ideally, we would like to see both to be above 10%. With the return on equity at 21% and the return on invested capital at 19%, it looks like TSM is very good at turning capital into profits, which is very important for any company, but especially for a chip maker like TSM because of the capital intensive nature of their business. TSM also has a very good S&P credit rating of AA-. Before we explore the issue around the recent news of the chip shortages and what it might mean for TSM, is there a buying opportunity for us? In other words, are they on sale? One way to look at this is through a tool called Fast Graphs. If we take a look there, we can see that the price line, black, went up like crazy in recent times. Unsurprisingly, TSM seems not to be on sale at all. On the contrary, even if it would return to the historical valuation of the market, blue line, we are looking at an expected return of negative 4.5% over the coming years. If TSM returns to fair value, the orange line, it gets even worse at 11.5%. Also, when looking at the dividend yield, they do not seem to be on sale at all. Their 4-year average yield is 3%, while their current yield is only half of that. So now that we know a lot about the business of TSM, what about the shortage in chips and why is this a big deal? Like I said before, the whole world revolves around chips and they are literally everywhere. In cars, phones, TVs, microwaves, refrigerators and so on. So if there's a shortage of chips, there will be a delay in the production of all those products. In fact, both Ford and GM have already halted production at several factories. How did this shortage come about? It is really a combination of factors. Dare I say, a perfect storm? Consumers started to stock up on laptops, gaming consoles and other electronics during the pandemic. People reportedly bought more cars and last year car factories were shut down to prevent the spread. Add the sanctions against Chinese tech companies to the mix and you end up in a situation like we have now. As a result, companies also start to stock up on chips, which even made matters worse. And TSM is in the middle of all of this as the biggest chip maker in the world. It is so bad right now that President Joe Biden has sought funding to the tune of $37 billion for legislation to supercharge the production of more chips in the US. This will take a while to come to fruition though, as it obviously takes a while before a complete factory is built and in production. So what does it all mean for TSMC? Is it a good or a bad thing? Basic economics can already tell us this is probably a very good situation for TSMC, since the demand is much greater than the supply, driving the prices up. On the other hand, there are some real risks for TSMC with this situation. Of course, countries are now made very aware how reliant they are on Taiwanese companies and Korean companies for a large part of their production processes, which they will likely want to cut down on. But again, TSMC is leading the pack for a reason. With their technology lead, they are able to mass produce chips that others, like Intel, simply cannot pull off yet. I think that this chip shortage will last for a while, since new chip factories cannot be built overnight, and the demand for chips will only keep increasing. Don't be surprised if it will still take a long time before you will get your PS5 or Xbox Series X. If you enjoy getting different stock IDs and analysis, be sure to also check out the Different Stock Battles playlist by clicking in the bottom right. More deep dive analysis can be found by clicking on the playlist in the top right. YouTube thinks you will like this video next. I'm off, until next time, bye bye.